Alright guys, welcome to my channel. This is my very first video. I'm excited to do these videos. I have a true passion for this stuff. As you can see, we have less than a minute until the close. Today was a lackluster day, but for the most part, these videos, I want to break down the market for you very quickly. And I want to teach you something educational, and then I want to show you guys how you could capitalize through trading options intraday, meaning one day, not holding to the next day. There's the bell, and we are closed. The ES S&P 500's futures closed at 32.31, up 0.84%. We had the NASDAQ today close at 10.663, up almost 2 percentage points. So tech led the way today. We have the Russell up 1.3% roughly. You can see the Russell had a nice day straight up. Going from the Russell, I don't like to look at the Dow. The VIX just got crushed all day. We had a bid come in around 11 to 11:30 and just basically crushed. If we also take a look at the VVIX, the volatility of the volatility, it was just crushed. Okay, they're crushing volatility right now. Who's they? I don't know, but let's take a look at the bonds. The bonds traded for the most part down today. So there's 8 indicators I like to look at: the ES, the NASDAQ, the Russell, the VIX futures, the bonds, and then I like to look at the XLF, which is the financials. Financials kind of flat on the day, down 0.82%. They kind of caught a little bit at the end. Normally when you see bonds drop, financials rise, which as you can see, bonds dropping here, financials rising there. Very little, because nobody really wants to buy the financials. And we have energy, which was basically even on the day. So energy, financials, and last but not least, the monsters of tech. This is a custom-made symbol with Facebook, Apple, Microsoft, Google, and Amazon. These are the top 5 companies in the markets. They're over $5 trillion, so they have a big weight. Literally up 1.6%. The NASDAQ up 1.9%. It's all monsters of tech out there. Monsters of tech held this market up all day. Here's an educational bit that I recorded earlier. I want to do more of these in the videos. They're going to be the focal point of the videos to teach you something new or something you didn't know or already know. Can't hurt to know again. So today I am talking about stocks, options, and futures. Just touching the surface of these products. You can't explain them all in one video. It's impossible. But you can get accustomed to these products going forward. So here's that clip, and then we'll bring you back and we'll see what was the best play on the board that you could have made some money today and walk away a happy camper. Alright guys, welcome to the educational section of my videos. Today I'm going to be talking about stocks, options, and futures. Oh my! Seems like a lot, and it is a lot to say the least, and I'm going to walk you through what each of the 3 products are and how they work. First, we have stock. Stock is probably the most common term you hear when talking about the stock market. It's what it is. Basically, you have ownership into a company. Owning 1 share of Apple is 1 share of Apple, and they have millions of shares. You're a small equity owner, meaning you have some ownership in that company. How stocks work, they go either up or they go down. So when you buy a stock, for the most part, you want that stock to go up. Otherwise, you're going to lose money unless you're shorting the stock. So when you buy a stock, it's called going long. And when you go long in a stock, you want it to rise. But when you sell a stock, it's called shorting. Going short, you want the stock to drop in price and you make the difference. So if you shorted, for instance, let's take Apple. So if you were to short Apple here at $377, okay, and Apple was to drop, let's say, $5, you would make $5 per share. Small amount of money, which is one of a con to trading stocks with a smaller account, but it's the safest way to trade in the marketplace. You're not using leverage, it's 1-to-1, meaning you're buying with what you have unless you have a margin account. There's margin accounts and there's cash accounts. Margin account, you can use some money as leverage to buy that you don't have, but you need to maintain a certain equity in your portfolio. Otherwise, it's called a margin call. So when you're bullish in a stock, it's up. Think about a bull's horn going up, bullish. And then when you're bearish in a stock, you want it to go down. Think of bears swiping. All stocks that are traded on the stock exchange are public companies. A private company, therefore, does not trade on the stock exchange, and they don't report earnings. They don't have to show their books or any of that stuff. Let's move on to options. Now, options are very, very complex, and I'm going to try to break them down for you guys so you can get a little understanding. It's going to be a lot. It's going to take a few videos, possibly 10. But for options, it's a contract. Think of it as the right to buy a stock. So it's a piece of paper, so to speak, that says I have the right to buy this stock at this price by this date. Okay? One contract is equal to 100 shares of stock. Okay? For the most part, you will never hold an option contract till the date of expiration unless you have a lot of money and you actually want to exercise that option. And when you exercise an option, that means you trade in the option for 100 shares of stock. One contract, 100 shares. One contract, 100 shares. That's the main point to grab from this. All options have expiration dates, meaning that it's not like a stock where you can hold a stock forever and it can just keep going up over the years. An option price, you have a timetable. The clock is always ticking, and I'll explain more on that in the future. So, I just want you to get a grasp. Options have strike prices and expiration dates and the underlying, which means what is that stock. So when we look at Apple, for instance, this looks crazy. There's a lot on the screen here. Apple's trading at $377.60. So the closest to that price, calls are on the left side. We got calls on the left and we got puts on the right. So when you, like stock, when you're going long, when you're buying, you're bullish, you're buying a call option. When you're bearish, you're shorting, you're selling, you want to buy a put option and you want it to go down. So options have basically bid and ask, so they have prices. So you have the stock that's trading at a certain price, and then you have the option trading at a certain price. So the more in the money you are, which is the shaded area, meaning that money, that contract is worth something, okay? So let's take the 330 for example. This contract expires on July 31st and it has 4 days left of life. The 330 is going for $47.75, okay? And it's constantly changing. And that basically means when I say $47, you times that by 100 or move the decimal point over 2 places. So that's almost $5,000 contract for one. But it has right now $47 of intrinsic value. You can see 330 plus 47 equals roughly the price of the stock, meaning that it cannot, as long as this stock keeps going higher or stays here, that contract will have value come expiration. But let's take a look on the flip side. Let's say if you bought a $400 call, now you're $23 underneath the price of Apple, okay? Which the price of this is going for $1.93, okay? That means $193. But if we don't reach $400 come expiration in 4 days, that option is now going to become 0. And as these days go on each week, because there's 4 days left, they're going to be less and less and less the more we sit at this price. But if Apple was to jump to $400, now it's going to have some more value, and depending on how much time is left, that plays a factor. So there's a lot of factors that play in options versus stock. It's up or down. It's simple, up or down. I'll break down options more in the future, but I just kind of want to touch the surface of this. This looks crazy on my screen. I plan on talking about the option chain later in the week, and I'll dive into it. I'll break it down. I'll try to make it so anyone can understand it. But that's options. So we know stocks now. We got a little grasp and understanding of options. And now let's take a look at futures. And futures are a big boy product. Futures trade 24 hours. They close at Friday, 5 Eastern p.m. and they reopen Sunday at 6 p.m. Eastern time. Okay, they trade throughout the day in between that time frame. Whereas stock market opens up at 9:30, it closes at 4 o'clock. It's as same as the options, and certain stocks will trade till 8 p.m. It's called after hours, and then there's pre-market, that's before the bell at 9:30. So let's say pre-market opens up at 7 o'clock. It's very light volume, not a lot of action because the real market is closed, and it goes to 8. But for the main purpose, 9:30 to 4 p.m. Eastern time is when the market is considered open or cash open because it's trading in the open hours. But futures are extremely volatile. It uses a lot of leverage. In this example, we'll look at the ES future contracts. You need over 13 grand to trade one contract of this. One tick size, so you can see on the right hand side, we're at 324. That's a tick is 0.25. That's one tick is $12.50. So a full dollar movement in the ES is a $50 gain or loss if you were long or short. So the main purpose for futures, I would say from a hedge fund standpoint, is to hedge their portfolios. Let's say something severe was to happen at nighttime and you wanted to hedge your portfolio, you would go to future contracts. And you can see here's the S&P 500. It's wild to say the least. But for the most part, don't worry about trading futures, but we do use futures to gauge the market and get an understanding of what's going on, because if the ES, when I say ES, S&P 500, when the ES is up, for the most part, think of it as a basket. The basket of goods are all coming up with it. The ES is down. For the most part, the basket of goods are going to bring a lot of stocks down. So let's go ahead and take a look at today's trading session. We're now closed after the bell, and let's see how someone could have capitalized on today's trading session. So now, how could I have made money today in this market, you may be wondering. For the most part, I don't like to look at individual stocks. I like to look at ETFs, an exchange traded fund. An ETF basically is a basket of goods that hold everything in it, and it moves as one. It's not one stock, but it's an ETF. And the ETFs that I like to trade in an intraday is the SPY, which mimics the ES, the S&P 500, and the QQQ, which mimics the NASDAQ. There's also the IWM, which is a Russell. So there's future contracts and there's ETFs of these future contracts and these indexes. So let's go take a look at the SPY. Okay, today if you would have bought the SPY, I don't like to buy in the first couple minutes. It's a straight gamble. If you're going to buy in the first couple minutes, you might as well go bet on sports because nobody really knows. We sold off right in the beginning, caught a bid. If you were daring enough, you could have bought a call option right here, an SPY call option, let's say a 320 call, and you could have gotten out around this range because we kind of consolidated sideways. We consolidated here. After this point, you could have been like, all right, well, we're not doing much. You, of course, would have to scan the field. What was everything doing at the time? Buying a 322 put would have been a nice option right here. Selling it probably around here, you could capitalize on that. We'll take a look on what you would have made. And then you could also bought a call here and rid it to probably here, depending on how gutsy you are. You could have held it to the close, but always get out before 4. Don't hold these things overnight. There's just too much uncertainty. You're trading intraday. You're not swing trading. So let's take a look at, let's clear that. Let's take a look at the SPY. What could we have done today on the 320s? So we look at today's, because on this, the reason I like the SPY is because they have 3 expirations in a week. They have a Monday, a Wednesday, and a Friday. And when you are day trading these, the best and most volatile ones to trade are the ones with a 0 expiration. So you can see the 0 right there. That means it expires today, so get out by 4 p.m. Get out. So if we would have bought the 320, all right, so let's pull a chart up on the option itself. Okay, so if we would have bought in, let's say we bought a 320 call option. Okay, let's paste that into there. This is the price of the option. So it opened up the day at $1.50. It ran to 280. It went from 280 back down to 180. And 180 we closed at 330. So you could have made nearly 60%, 70% today if you played your cards perfect, but nobody plays the cards perfect. It's nearly impossible. So that's why you're not trying to get greedy. Don't get greedy, get your profits, get out. So if you would have bought in a put here, it would have been on the flip side. So let's change this up here to a P, and let's change this to a 322. So this put, see, now it's worth $0 because it is out of the money. I explained that earlier when I touched on options. Out of the money, get out. It's worth 0. And the call option expired today in the money at the 322 one. We were just looking at the 320. But those are where probably would have been the best trades to do, just looking at an index overall. You could have targeted the Qs, but the thing with the Qs, they don't expire every day like the SPY. They're weekly, every Friday. So when you are buying an option intraday that is further out, I'll explain more in the future, but you want to have a higher delta, which I'll explain more down the road. But for the most part, today wasn't a great day to make trading, but doesn't mean you couldn't have made money today. Hopefully tomorrow there's a better session to trade with, so I can show you more. But if you have any questions, comments, concerns, don't know what I said, comment below and I'll write back to you. I'll explain it in text what it means so you get a better understanding. But my goal for these videos is to post every day, Monday to Friday, with an educational bit, break down the market, and show you how you can capitalize. Just boom, boom, boom. Hope you guys like. Leave a like if you liked, and subscribe. And I'm looking forward to doing this because I'm really passionate about this stuff. The reason I'm doing these videos is because when I talk to people, they just are like, what? They're confused. So if they're confused, most likely other people are confused. And if I can break it down little by little, day by day, and have archives of stuff, they can just go look it up. But my name's Tino. Take care and trade safe.